started with this position. You're right. 7-Eleven. Slurpee Day. I got into
Do they still do that?
I think so. I don't think you can get like a gigantic one. I think it's just a small one.
Yeah, they got to cut it down for inflation. You know, you can't have everybody getting the massive big gulps.
That's correct.
Fair.
So yeah, started with a put calendar here. Just wanted to get small to the downside. But the whole intention with this trade and the whole reason why I put this trade on was because I knew that I could roll into the earnings cycle with this trade, and that's ultimately what I did. But I started with the 290 long put in September and the short put with 10 days to go. Paid $12.38, which is an expensive calendar. But again, I knew that I could roll into the earnings cycle and collect a big credit to reduce the basis on this trade. So stock price started rallying pre-earnings. So what I did was I bought back the 290 short put and I moved it to the 280 short put and basically rolled the put out and down and turned it into a diagonal for $4.40. So immediately reduced basis from $12 to $8-ish, $7.98 exactly. And that was after a couple of weeks. The stock continues to climb, goes from 302 to 311, and I obviously did not get the direction right, so I moved my put diagonal from 290 to 280 back into a put calendar, and I moved that up for a tiny credit of 32 cents, just kind of making sure I still have some sort of short premium on there. And the stock was so far away from the long and short strikes that it didn't really matter. I would still be benefiting if we got a sell-off closer to 290. Same thing happens again. Market's kind of just flat right at 310, 311. So I rolled again from the 290 short in the August 14 day into this September cycle. So basically moved this out again for another 98 cents, bringing my basis down from 766 to 668. So already over the course of less than a month, I reduced basis from 1238 down to 668. So cut it in half. Which basically means if all these options expire worthless, I've reduced the initial debit risk by 50%. We finally get the move that we needed, and I moved the 290 put from the calendar into the 282.5. So I reestablished the diagonal spread from the calendar, moved it out a week, and moved it down 7.5 points. And I was able to do that for a 95-cent credit. So this is kind of because we're now closer to the strikes, I leaned short again because that was my initial trade idea. And I was able to do that for a credit. If I wasn't able to do it for a credit, I wouldn't have turned it into a diagonal, but because I could, I ended up doing that. And then we got a couple of days of movement, and now we are right where we are at 285-ish, and I was able to close that position for a $260 net profit, selling out of it for $8.35. And because of all these rolls, $4.40, 30 cents, a dollar, my initial debit cost went from $12 down to $5.73, and I sold out of it for $8.30. So.
And your adjustments, your 32 cent and 98 cent, where you're rolling to that 290 strike. If you had tried to move it to the 282.5 or the 280 strike, you would have done that for like 5 cents or maybe even a debit. It probably would have cost you a debit, to be completely honest, to do that roll. You needed the stock to come down a little bit for you to roll out of the money there, because you're over that period of time from the 4th to the 17th. The stock does go down, but you're also getting that extrinsic value decay. So you're able to roll that out and down for a net credit. The other situations where you're rolling just the 290 strike, the stock hasn't come down enough to make that option, that further out of the money option, have enough value to offset the roll and do it for credit.
Yep, exactly. So here's the visualization of this. So initially, the long option, this green horizontal line, this is where my long put is, and the red dotted line is where my short put was and was throughout the trade. And then, of course, the blue line is Meta stock price flying around from just under 300 to above 310, back down to 290, all the way up to 320-ish, and then slowly trickling down as the market has sold off over the past couple of weeks. So started with the calendar. kind of rallied, dipped a little bit, moved it into that put diagonal spread. And then of course we get the complete reversal. So I moved this put diagonal spread back up to the calendar, rolled a couple times, and eventually got them moved back down to the calendar. So I was able to push the short option out in time and move it down to create the diagonal spread again. And we finally got the move, after all this time, we finally got the move below the long put, which is why this trade ended up being profitable. But again, it wasn't from the long option. If I had just bought the long option and didn't have the shorts against it, if I did the same sort of time frame, it would have actually been a losing trade, which is always interesting to see.
Yeah.
So this is a risk graph and just a price change of the actual long option itself. So on any position, any option, if you right click on it, on the trade tab, you can graph that actual options price as opposed to the stock price. So the opening price here of the long option was right around $15, $16, and I had reduced basis by selling that initial short put. So my total cost was $12 and change. But as you can see, from the opening trade around $16, $17 to the closing trade of around $12, $13, if I didn't have that short option reducing basis, it would have been a couple $100 loss if I didn't close on this spike here. So from the open to the close, if I did the exact same thing, it would have been a $300 loss-ish.
Yeah, and I added in that little box on the bottom because we get that question all the time of like stuff that, you know, is left over that we can't sell anything against. And we'll say, you know, like we have that Nike position, the 115 call. At a certain point, your option, and this one has a lot of value, right? It's trading at $4 or $5. That's a big position. But at a certain point, if you're wrong on the direction, the risk on that position has already been realized, right? So you took that option from $15, $16, $17, and now it's trading at $3 to $5. That $10 or $12 of risk is already marked to your position, right? So going forward, your risk is a lot less than what you have already marked on that position. And that's why, you know, even though that stretch of time, which was a long period of time, like almost, I don't know, a couple weeks, 3 weeks there, 2 weeks, 2.5 weeks of time, that long option didn't really move, but the stock was still, you know, moving higher. It was kind of chopping around, but it was much higher than where you initially started your position. So the rate that your option was decaying once it gets to a lower amount is much, much slower in that time frame. And so, you know, your risk was already on the table. You had already realized that the pain and holding the position going forward didn't really hurt you in that period of time to allow you to wait out and hopefully get bailed out on the move, which is what happened in the last week or so of that position.
Yep. And yeah, really the initial credit received from moving it into the earnings cycle reduced basis in a big way, but I was still able to pick up $1 here, $1 there, and that goes a long way when you look at the long option chart here.
Yep.
So this is another snapshot of the order chain. So if you have your order chains pulled up on any position, if you right click on any of the adjustments, you can look at this market snapshot. You can look at theta, you can look at the underlying price, and it just graphs whatever metric you're looking at. So just like with our diagonal spreads and crab trades, whatever, the short option is the cost basis reducing factor against the long option, and the long option is our asset in the trade that we want to appreciate. But if it doesn't, we still have this kind of temporary mulligan effect with the short option where the short option's theta number is usually going to be a higher number than the long option. And that's especially true if it's on the same strike. So over the course of this entire trade, pretty much, I was able to still maintain a positive theta because I had a short option on against a long option, and the short option being more near term, it's going to have a higher raw theta number than the long options, which just means that all else equal, if we're just looking at the passage of time and the decay between the long and the short option having a more aggressive decay than the long means I'm going to have a positive theta. I'm going to offset the negative decay on the long option with the positive decay on the near-term short option. So pretty much from the beginning, because I had that short option on against the long, I was able to keep that theta positive, continue to offset the long option's decay. And again, that's why this trade ended up being profitable. The long option by itself ended up losing value from open to close, but I was able to collect premium along the way and continue to pile up the credits in the short, which offsets my total cost basis on the overall position. And it allows me to close the trade for ultimately less than what I opened it for to start, because I had collected so much along the way. So
yeah,
always important. And having the short option on just means you don't have to be as directionally correct to still be profitable on a trade or get to a trade to a scratch. And that's always
the first two dots here, the first two adjustments. That's when your position, you were selling the most extrinsic value, and that's why your numbers are relatively higher than everything else, right? The second two are when we were looking at that period of time where the stock stayed higher and your long option really didn't move all that much. That's kind of that period of time, because the decay of that option, the value of that option had already come out, right? So the next level of decay was much slower, and that's why you kind of were sitting around that zero or very small theta number at that point. So you started with high extrinsic value because you were doing it in, was it an earnings event? I believe it was.
the first one was before earnings, and then I rolled
and then you rolled into the earnings. Yeah. So you had, this binary event, this high extrinsic value, you're selling short duration premium. That premium is going to decay very quickly. That's why your numbers are on the higher positive end. The next part is where you got the move against you. So you have that marked loss on the books for your position. Your rolls are for a minimal amount of credit. So your theta is very flat on those two positions. Then you get to the last 2 points where you start to basically need the directional move, right? So you've gotten all your hedges out of the way that have kept you positive theta through that first, 3-4 weeks of the trade. For the second part or the third part of the trade, you needed to have the stock move in your direction to make that money back. You didn't have the positive theta, the mulligan position on for those last two adjustments. Those adjustments were all directional, and that's where you got the move you needed to make it out of the trade positive.
Yep. And at the end of the day, you need two-sided action. If you're initially wrong and you get a big move against you, you need two-sided action for that long option to get back to some actual value. But even if it didn't, I still would have reduced basis in a big way because of the continued rolling of the short options. So luckily we got the move prior to the expiration of the long, but it happens a lot. It doesn't happen always, but it still happens. We've done multiple anatomies recently where it has happened. So, glad to see it.
Cool.